Hello and welcome back to All Things Money. I'm your host, David Blaine. In this final segment of today's show, we're going to continue our discussion about why people that have accumulated fortunes fall out of that top 1% and what do the people do that stay in that 1%. We talked about how today wealth, the volatility of the financial markets and the housing markets and everything is causing people's wealth to rise and fall at sort of an alarming rate. And this applies to, just because you're not in the 1%, a lot of this applies to just regular people trying to save for retirement and have accumulated something for retirement as well. So I want you to pay attention to these principles and make sure that you follow them. So the first one we talked about, why these people, we talked about 30% of the folks in the top 1% in 2007 were not there in 2009. What do they do wrong? The number one thing, well, I shouldn't say number one thing, there were about 5 things. The number one thing we're going to talk about was over-concentration. The rapid growth of wealth for a lot of people is due to one factor. If you're in a diversified portfolio and you're saving $1,000 a month over a lifetime and investing it in stocks, bonds, and gold and commodities, real estate, your wealth is not going to zoom up one day and then crash the next. But what we see with people that rapidly accumulate wealth, whether they be a sports star or they invested like Paulson, bet against the housing market, Bill Gates, Microsoft, Steve Jobs, Apple, these type of things, is they have a huge concentration in one thing. We're seeing that today with people that invested in gold. I mean, they've made a lot of money in gold, and they have all their money in gold now. And this does lead to rapid rise in wealth, but it also leads to rapid falling, that they over-concentrate. And so one of the basic principles, even Warren Buffett, when you look at, one of the things he preaches is, concentrated investments, and he'll go out and buy the whole company. Well, if you look at his portfolio in Berkshire Hathaway today, they own a number of companies in a number of different industries. And so it may be concentrated compared to owning, thousands of companies, but it's very diversified across different industries and things like that. And so that's number one, is don't make huge bets on specific investments. Now, if you're in there and you're growing a company, obviously you've got to put a lot of your effort in it. But even Bill Gates or these folks, they're regularly selling off part of their stock to diversify their investments. That's one issue that we see, is over-concentration. Number 2 is leverage. Leverage, both investing in markets. You see, that's what brought down Lehman Brothers. I don't know if you remember, leveraged 100 times. You see that a lot in real estate developers. Because real estate can be leveraged, you can put 20% down and control 100% of the value of the real estate. So over-leverage, people get over-leveraged. And we saw it a lot, especially when you take that leverage and then you go spend it. If you mortgage up your home and take all that money out to go buy a car or pay for your kids' college or something, if you spend it, it's gone. I mean, it's one thing if you're leveraged into an asset that has the potential to provide some sort of cash flow. That's one thing. But a lot of people leverage it and then spend it. So you want to make sure that you keep the leverage to an absolute minimum. And of course, it comes down to spending. The number one rule is if you spend less than you make, it's physically impossible to go broke. And so keeping the spending level down is very important. Someone that goes, they invest in a tech startup or, some real estate development, all of a sudden they make all this money, the tendency is to run out and spend it. Athletes are one of the worst offenders of this. Entertainers, I was reading the other day about some entertainer that actually saves part of her salary, and they were saying that is so unusual in Hollywood because these folks, they get these ongoing royalties from either music or movies or something, and they generally don't save anything at all. Family issues bring down a lot of the wealthy. Either divorces, I always say the best financial investment you can make if you're married is in your spouse, because if you get divorced, you can count on a minimum of 50% of your wealth going out the door. So that's one thing you should always invest in, is invest in your marriage. Make sure it's strong. Make sure you are, have a solid marriage, because it's very difficult, especially for, someone that's accumulated over say a 20-year career, and then they get divorced. Their $1 million they've saved, half of it goes to the other spouse. So family issues come in when a patriarch or matriarch of the family dies, and the squabbling, of course the lawyers come in, and before you know it, the entire estate is consumed by legal fees. I've seen that with divorcing couples too. They'll spend $100,000 between the two of them trying to divide up $1 million estate. I mean, that's 10%. That's absolutely ridiculous. The same thing happens when a family business owner or something like that dies. I mean, the lawyers swoop in, and before you know it, every kid has his own lawyer, and the fees are just going out, and it really destroys some of the family wealth. You see that happen all the time. Okay, so what do you do to prevent that? Like I say, keep the spending down, keep the leverage down, don't over-concentrate, and make sure you have a good, healthy family life. Whether it's spouse or you work in a family business, make sure you've talked about these issues and have a plan of action for when someone passes away. The other basic principle for keeping wealth is dividing your wealth into what we call two buckets. And this doesn't mean you have to physically divide it, but at least on paper or somewhere, is you've got to have a spending bucket. And this applies whether you're wealthy or not. If you're living the majority of on your investments, is you've got to have some sort of discipline in the spending area, such that you have enough resources to provide the level of spending you need. This is what we call the spending bucket. It doesn't have to be a separate account or anything, but it has to be calculated, and that number needs to be determined. How much can you reasonably spend, and make sure you have assets that can generate that income on a reasonable ongoing basis. Then number two is what we call the appreciation bucket, and this is where you go out and you continue to take risk with the money. You try to grow the portfolio faster than inflation. You try to continue to accumulate wealth for future goals, funding, whatever your future goals may be. And so that's how you do it. And it all comes down to spending. As I said, if you don't spend more than you make, it's physically impossible to go broke. Well, that's about all the time we have for today's show. I hope you've enjoyed it. If you missed it, head on over to the web, dlblaine.com, and we'll have an archive posted in a few days. So for All Things Money, I'm your host, David Blaine.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.